Welcome to the Deep Dive. Today we're getting into a strategy that aims to, well, optimize your retirement income.
Yeah, and also potentially cut down on taxes long term.
Exactly.
Yeah.
We've been looking at some material. It's from Diversified Insurance Brokers, and it details a strategy using Roth conversions, specifically with a tool called a fixed index annuity.
Right, the North American Charter Plus 10 specifically.
So our mission really is to figure out how this strategy actually works, what the potential upsides are, and how it might fit into different financial plans.
It's about understanding this mix of Roth conversions, the tax side of things, and this particular annuity product.
So the basic idea is moving money from a traditional IRA to a Roth IRA. Let's just quickly touch on that difference again.
Sure. So traditional IRA, you usually get a tax deduction now. The money grows tax deferred, but then withdrawals in retirement are taxed as income. Roth IRA, you put in money you've already paid tax on, it grows tax-free, and qualified withdrawals later are completely tax-free. Big difference.
Okay. And the tool here, this fixed index annuity, the North American Charter Plus 10, what role does it play? What are its key features?
Well, like many fixed index annuities, it offers tax-deferred growth. So while the money's in there, you're not paying taxes year to year on the gains.
Right.
It also has downside protection, which is a big draw for many people, protecting your principal from market losses.
And crucially for this strategy.
Crucially, this specific one has a premium bonus, an upfront percentage added to your initial investment. That's pretty central to how these scenarios work out.
Got it. Okay. The material lays out two scenarios. Let's talk about the first one. Doing a full Roth conversion all at once. How does that look?
Okay, imagine you've got $100,000 sitting in a traditional IRA. You decide, right, let's convert it all to Roth. Boom, that triggers taxes.
Because you haven't paid tax on that traditional IRA money yet.
Exactly. So using their example, say you're in an 18% federal tax bracket for that conversion amount. That's an $18,000 tax bill right there.
Ouch. So you're left with $82,000 after paying the tax man.
Correct. But then according to this strategy, you take that $82,000 and use it to buy the Charter Plus 10 annuity. And remember that bonus.
Premium bonus. Yeah. How much is it?
In this example, it's 21%. So you put in $82,000 and immediately get a 21% bonus added.
Okay, let me do quick math. 21% of $82,000 is around $17,220. Add that back to the $82,000.
And you land at $99,220.
Wow. Okay. So you paid the $18,000 tax, but the bonus almost immediately bumps your account value right back up near the original $100,000.
Pretty much. And now that $99,220 is in the annuity, positioned inside a Roth IRA structure. So potential future growth and eventual withdrawals could be tax-free.
So the bonus kind of cushions the blow of the upfront tax payment.
That seems to be the idea, yes. It helps recover that initial tax cost quickly. Now, the other way they suggest doing it is through partial conversions.
Right. Scenario B. How does that start?
This time you take the full $100,000 first and put it into the Charter Plus 10 annuity within your traditional IRA. You get that same 21% bonus.
So the account value jumps straight to $121,000 inside the traditional IRA.
Exactly. Then, instead of converting it all at once and facing one big tax bill, you do a series of smaller partial Roth conversions over several years. Maybe $20,000 a year, $30,000, whatever makes sense.
Ah, okay. And the goal there is?
To manage your tax exposure each year. Spreading the conversion out means you might be able to keep the converted amounts within lower tax brackets each year, rather than pushing yourself into a higher bracket with one massive conversion.
Makes sense. You control the tax hit year by year.
Precisely. And another point they make is that as you do these partial conversions, the money moves into your Roth IRA. Eventually, you can consolidate these into just one Roth IRA contract holding the annuity.
For simplicity.
Yeah, simpler management for things like taking income later, handling beneficiaries, deciding on allocation options within the annuity, that sort of thing.
So the trade-off is you still pay tax on each partial conversion, but you spread it out.
Correct. It's a different approach to managing the same fundamental tax issue.
Okay, stepping back, what are the sort of overall advertised benefits of using this annuity strategy for Roth conversions?
Well, you get the tax-deferred growth potential within the annuity itself. You get the downside protection we talked about.
Right.
That premium bonus gives a potential initial boost, which is key to offsetting conversion costs or just starting with a higher value. And the end game is aiming for more flexibility with tax-free income in retirement via the Roth structure.
And obviously, this isn't a one-size-fits-all thing. The material mentions customization.
Absolutely. Diversified Insurance Brokers stresses that they tailor it. Things like how long until you need income, what your current and expected future tax situation looks like, your overall goals. That all feeds into whether this or which version of this makes sense for you.
So it definitely sounds like something you'd need to discuss based on your specific circumstances.
Without a doubt.
Okay, so just to wrap up our deep dive here, we looked at a strategy using a specific fixed index annuity, the North American Charter Plus 10.
Right. Using it as a vehicle to move money from traditional IRAs to Roth IRAs, either all at once or bit by bit.
The idea being to leverage the annuity features, especially that premium bonus, to potentially manage the tax impact of the conversion and set up tax-free income later.
We saw how the full conversion uses the bonus to quickly recover the tax cost, while the partial method spreads the tax hit over time.
So a final thought for you, the listener. How much thought are you giving to the tax implications of your retirement savings down the road? Beyond just saving, exploring different tools and proactive tax planning, like these conversion strategies, could potentially give you more control and maybe even more efficiency in the long run.